I am extremely pleased to announce to you Thomas Faber and Philipp Schulden from Rudy Capital speaking on building market-neutral DeFi portfolios. The stage is yours.
Thank you, Marcel. Today, we're going to present, as Marcel told you, about building market-neutral DeFi portfolios. So we're going to shed some light on that topic later on. But at first, I want to introduce myself and Thomas real quick. So I'm Philipp. I'm the co-founder and COO of Rudy Capital, and I'm also joined by Thomas Faber. He is the CIO and also co-founder of Rudy Capital. And when we talk about market-neutral DeFi portfolios, the question arises, why do we actually need market-neutral DeFi portfolios? And with our talks with institutionals, with banks, wealth managers, and so on, there are actually 4 different problems evident. Exceptional return opportunities, but there are still significant challenges which are preventing institutionals in investing in DeFi. So at first, there's an extremely high volatility in DeFi products or in crypto assets in general. So for example, when we look at Bitcoin, the max drawdown was 83%. The second problem is a difficult risk assessment. So with today's risk models, we cannot really assess the risk of DeFi products and of crypto assets. Then thirdly, to actually invest in DeFi, there's deep expertise required. So you require specific expertise, and it really has become exclusionary as a result. And as well, it's really complex still. So the user interface in DeFi is pretty complicated. We have opaque regulation and a really fragmented investment infrastructure. And we as Rudy Capital, we are actually handling these problems. So what we are doing is at first, in the next slide, doing market research means we are actually create and aggregate market intelligence with DeFi. Then secondly, we do the risk management. So we are building sophisticated risk management systems for actually managing the risks. And thirdly, we are also doing portfolio construction. So we draw on the main revenue sources of DeFi and then build portfolios. Right now, I cannot see. Right. So then how are we doing that? We're actually building stablecoin-based and market-neutral DeFi strategies to actually then counter or zero out the market volatility as a whole, and then to generate unprecedented risk-adjusted returns. And this is really important, whether the markets are rising, falling, or trending sideways. And what are the instruments we are using? So we are at first using stablecoins. Stablecoins, as you all know, mimic fiat-like behaviors while obtaining the mobility and utility of digital assets. And our second source are so-called market-neutral strategies. And there we mitigate market risk and volatility while improving the overall returns in addition to our stablecoin positions. What are the metrics here? So you can see here exemplary backtesting from November 21 to now April 22. So with our construction, we managed to have a maximum drawdown of under 1%. So we zero out the volatility. Then we, with that strategies, you could generate strong returns, so up to 25 annualized return. And you can minimize the correlation to other digital assets and traditional assets to under 0.01. Right here, another snapshot that you see how this magic works. So what we always say is we don't want to be better than Bitcoin, but what I can see here is a snapshot from November until January. And there the Bitcoin experienced a pretty dramatic drawdown of nearly 50%. And the blue line you can see above is the line of our backtesting. So you see, except the Bitcoin experienced a massive drawdown with our constructed portfolio, we generated constant returns of about 5% in that time.
Yeah, so at this point of time, you might ask, where does that yield, the return, actually stem from? So as you can see, there are 3 main pillars that we draw upon when we construct a portfolio. Number 1 is lending income. So most of you probably have heard of lending protocols in the DeFi space. It's basically what happens in the traditional finance world, but automated by smart contracts. I will have an example with me shortly. And the second pillar would be trading fee income. So during the conference, we've heard quite a lot of times the word DEX, decentralized exchange, or automated market maker. And that's actually what trading fee income is. You become part of the market making mechanism, and you provide liquidity to an automated market maker in order to make trades more efficient. And as a result of that, you get a share of the trading fees, of the swap fees. An example could be, let's have a look at the Uniswap Ether USDC pool, for example. So in a 50-50 ratio, you just supply assets, you supply 50% Ether and 50% USDC. And then there is a trader who wants to swap USDC for Ether. So he's utilizing that pool, and for utilizing that pool, he's paying his fair share to actually settle the trade. And part of that fees, get to people that provide the liquidity, and some remains with the protocol, with, for example, Uniswap in that case. The third pillar would be reward income. Reward income is a result of incentive programs of protocols. For example, if you use the Curve protocol, or if you use the Balancer protocol, they incentivize using their platform so you get basically their protocol native token as a reward for using their platform. That's mainly done by younger protocols to incentivize growth of the platform, but also by established protocols, as I just said, for example, Curve. And so typically it's not on the same level as lending and trading fee. It can be more thought of as a bonus on top, because when I lend with a certain protocol, then I get some rewards on top. Just a quick example for those of you watching that have not heard of a decentralized lending mechanism. We have the DeFi platform here in the middle. On the left, we have our lender, and on the right, we have our borrower. So how lending typically works in DeFi is that the borrower has to provide some collateral as a security in order to be able to borrow funds. That means that, for example, you could, let's just consider the following use case. You are a big Ether fan and you want to remain your exposure to Ether, but you are also in need of cash. So with that lending protocol, let's just say Compound, you can lock your Ether as a collateral, and for locking that collateral, you will be able to borrow some funds, and those funds could be stablecoins, for example. So you can lock your Ether, remain exposed to that asset, and still borrow a stablecoin that you can transfer to a centralized exchange and cash it out and buy a car from it, for example. So how that typically works is that the smart contract automates that whole process. So whenever I put my collateral into the smart contract, it's constantly monitored. So let's just say Ether drops very heavily in price, then at some point I get liquidated. So the lender on the other side can be sure that he receives his money back. What looks complicated at a first glance is just a quick illustration of an example process, investment process, what we call the multi-chain anchor strategies. So some of you might have heard about the new UST stablecoin on the Terra blockchain, maybe even of the Anchor protocol. It's basically a lending protocol. And following the process, we start with euro on a traditional bank account. We wire that to Coinbase or Coinbase Pro in that example to on-ramp it into the crypto world, exchange it for a US dollar stablecoin, USDC in that case. And now it gets interesting because from the Coinbase wallet itself, we can't do very much. Although the centralized exchanges have done a pretty good job in integrating some DeFi functions, DeFi protocols as well. But we need to transfer it to our wallet to be able to draw upon the full spectrum of opportunities in the decentralized space. So we transfer it to our Ethereum wallet and have to swap it then again for another stablecoin, UST stablecoin, because Coinbase doesn't have it, doesn't have it. And so the next steps are a bit complicated, but what actually happens is that those funds will be automatically bridged to a different blockchain, to the Terra blockchain, and then deposited in Anchor lending protocol. So that's an exemplary process. Anchor protocol is pretty cool. So if you want to look it up, there are some doubts on its sustainability lately. So it has been a pretty good investment with 19.48%, 19.5% yield on stablecoins, actually for the last couple of months. It will go down eventually, but still a good opportunity to learn. So I recommend it to everyone to have a look at it and read through the docs. So yield is, high returns in DeFi are great. We've all heard about thousands of percent that you can get and so many opportunities that you can miss. But in the end, what really matters are risk-adjusted returns. So Philipp has talked earlier about how difficult it is to assess risk in the DeFi world because it's just a whole different level. It's not about volatility anymore, at least not in the context of the strategies we're discussing. It's about different layers of risk. We have risks on the blockchain levels. We heard that Solana has paused the blockchain a couple of times. We know that some chains are more centralized than others. On the protocol level, we have protocols that have been hacked a lot of times. We have protocols that are not audited. We have protocols that have undergone several audits and so on. We have good developers, bad developers. We have good tokenomics, bad tokenomics. And on the asset level, we have centralized stablecoins. We have algorithmic stablecoins and so on. So yeah, every strategy in the DeFi world is a combination of those three layers: blockchain, protocols, and assets. And that's what makes it so complicated to comprehend. And that's why we have developed different risk models to actually assess that risk and to bring those returns in a good perspective. Just a quick overview on how that is done. We've built a strategy pool that consists of more than 500 stablecoin positions, stablecoin strategies, and market neutral strategies at the moment. And what belongs to that, it's, as I said, lending, liquidity mining, and so on. But we also have hedging strategies like shorting perpetual futures. We engage in some staking opportunities, but we also insure our funds if possible. And we run all those strategies through our risk return assessment. So I touched on it very quickly in the last minute, but we have a look at smart contract risk, financial risk, centralization risk. We also look at market sentiment, how stable the returns were, and so on. So those are more than 50 qualitative and quantitative metrics and a lot of manual work. And in the end, we get 12 to 15 strategies that we select that are most attractive. Yeah, that would be it. If you have any questions on what we've just presented to you, please let us know. You can reach us on info@rudy.capital or check out our website on rudy.capital. Add us on LinkedIn, Thomas Faber and Philipp Schulden, and happy to take some questions as well.